U.S. Treasuries took that.
Listen up, rebels. Rebel Leader here. In last week's debrief, we talked about market volatility and how to avoid it by joining big tech, right? But today I want to talk about why you want volatility in your portfolio, or why you would want to enter a stock with volatility, because the gains are greater or potentially greater. You don't even have to leave big tech to even see volatility. So talked about entering Facebook, Amazon, Apple, Google, even Netflix or Disney. These are great companies that you all probably know of. You probably use them and watch them, every single day. And it has great brand power. If you look at where their stock price can be in 2, 3, or 5 years from now, you're talking about a 2x, maybe a 3x, but you're not talking about something like a Revolve that can 5 to 10x over the next, 2 to 5 years. And that's why we diversify our portfolio, so we have, some safety in these big tech, non-volatile stocks. But you also have some volatility in these, smaller, newer growth stocks, because they have a lot of room to run over the next few years. And they're emerging. They're not a household name yet, but they can be. And if they are, then they win big and you win big. And that's basically the story of Tesla that just happened last year. So now, which stocks would you get in big tech for some major volatility? And that is going to come down to two great ones that are actually very close to Amazon and what they do, e-commerce market spaces. One of them is Alibaba, ticker symbol BABA, and the second one is Jumia, ticker symbol JMIA. Really interesting if you look at what these stocks have done over the past year. Basically, Alibaba, it's basically the Amazon of China, Asia, and that entire hemisphere. It really runs through Alibaba. You probably know a lot of YouTubers and people in the US who use Alibaba for dropshipping, or even cheaper prices on mass bulk orders off of Alibaba versus something like an Amazon. That's what they're known for. They have a great branding power in China specifically, which is a growing consumer market, very fast, very populous area. They even have Jack Ma, who was the CEO and chairman of Alibaba. He's basically the Jeff Bezos of China. And what they've been able to do in Alibaba is expand wildly just as fast as Amazon. But surprisingly, the stock price does not reflect that. So it's currently extremely undervalued, this company. And the reason is because people are discounting it simply because it is a Chinese company. And there are different rules and regulations about porting, and people are uncertain about that government and hesitant about investing in something that communists run and something like that. But business is business, and if you look at it from a purely business standpoint, Alibaba should be much highly valued. It should be pretty close to Amazon's valuation. So you have Alibaba hovering currently around $200 a share, but just months ago the stock was around $300 a share, and now it's dipped substantially below that because of some Jack Ma controversy. But the business fundamentals did not change, the growth prospects of this company did not change, and it can easily reach back up to not only the $300 return to there, but $400, $500 a share pretty quickly. You can see how quickly market sentiment can turn. And as second half this year, if Amazon and big tech sees a run, pulls up all these other companies in the big tech space. Just to differentiate some market caps here of how big these companies are, to show you the scale, and meaning why they're going to be more volatile. The smaller market caps that you get to, it's just going to be greater volatility. So Amazon is currently hovering around a $1.7 trillion market cap, which is the current value of that company. It's about to hit $2 trillion. There's no doubt in anybody's mind it will hit there, and it could keep going up and up for the coming years and decades. But a company like Alibaba currently sits around $600 billion market cap. So it is about like a third of the size. That's something really to think about, of how much room it has to catch up to Amazon. But of course, you can say that Amazon is worth more, so it deserves that valuation, but maybe not that steep of a difference. And if you kind of see if Amazon's gonna grow there, there's no doubt that Alibaba can reach $1 trillion market cap and keep going up from there. And then we have to talk about Jumia, which is the best way to describe it, because these are all online marketplaces, is an Amazon of Africa, in particular South Africa. A lot of people are kind of scared of investing in a company like this, which is innovating not only delivery, but like online marketplaces, and the relationship between the seller and the small businesses, and really ramping up of what is able to do with technology, the spread of technology in Africa. This company basically took Amazon's idea and implement it into the infrastructure, which is insanely hard to do in Africa. So now Jumia is delivering packages, they have their online marketplace up and running, and it's only getting better, doing crazy numbers. They have their own Amazon Day type deal on there, and we're seeing the numbers that are coming out, they're just staggering, because there was always a need for it, but nobody ever came in. Amazon can't go all over the world. Maybe one day, but for now, they're really focused on the US. Their expansion is really, in investing in themselves in big tech, and maybe one day they'll expand, have a more global presence. But for now, you need these other companies to step in there and really be able to take the infrastructure and the government regulations. You have to know the land that you're delivering to. So Jumia is this brand new up and comer, and where I said Amazon is almost at a $2 trillion market cap. Alibaba is almost at a $700 billion market cap. Jumia is currently sitting around $3 billion market cap. That is it. That might be 200 times smaller than Alibaba. That just means it has the most room to run if it is successful. And I think that's important to note, that even this past year, in June 2020, this company was hovering around $5 a stock. It ran all the way up to $70 a few months ago, and now it came back down to it's hovering around $25, $30 a share. Even if you bought in the $5 range, no matter what, you're still up tremendously at 6x right now. If you buy in now at $30 a share, and this company probably will return, in my opinion, to that $60, $90 a share range in the short term, it has a lot to prove itself. It needs to really double down on its capabilities in South Africa. But if it does, this can run up to 200x. It doesn't even need to reach Alibaba's valuation to be successful. If it can run up to its peak, its greatest point, if it can run up to $20 billion market cap, or even a $50 billion market cap, which is still a fraction of the share. Maybe it's like 1/10 of what Alibaba is doing. You're still winning, and that's because you're taking advantage of the volatility of the newcomer and the small business model currently. People are often discounting it, heavily undervaluing, and you're taking advantage of it. Everybody loves an underdog story. You look no further. People tend to think that there's no wealth in Africa, but that's just a misconception. A lot of times people don't understand. And Jumia is actually based out of South Africa, and that's their main target, but also they'll expand to the rest of Africa. But there are some very wealthy places in Africa, in South Africa in particular. It's really a great place, and maybe just do some Google search, see some YouTube videos on the country itself. I think people still discount Alibaba because it's in China, because they don't really understand the geography, the landscape, the government, what's going on there. It's the same thing for something like South Africa, Jumia. Amazon, Jeff Bezos, what the US government's doing. Even if they're gonna break up them with antitrust laws, that probably won't go through. You kind of understand, you kind of feel better about it, but then just do some research. It's really what's gonna make you more confident against all the volatility. And I think you have to be confident in these decisions when you enter these highly volatile stocks. Otherwise, that's just a recipe for disaster. You're gonna probably lose a lot of money in these stocks if you pull out too soon, or you pull out on a major dip and not wait the 1 year at least it's going to take for these companies to have a run. For volatility, you literally don't even have to leave big tech, and I think that's important to note. If you wanted to invest in online marketplaces and big tech like that, you can put like a third of your money in each of these companies. But again, big tech should only be a small percentage of your portfolio. If you put all your money in these three companies, you'll probably be fine, but you're not actually diversified in terms of what you own. You're owning all big tech, and you're owning all online marketplaces. That's not really a smart play, but it would be a heavy bet on the rise of Amazon and its success and these newcomers in the online marketplaces, which is not a bad bet. It might not be a bad bet. Everybody's different. You have to know what's important to you based on your research and how heavily you want to bet on it. If you take a little bit more heavy of a stance on something like this, on big tech, and you put all your money in it, it can be kind of a bet mentality. I try to lean away from that as much as possible and make it more of an investment mentality. And that's why we diversify, right? And if you have seen this past few months your portfolio go down, we always want to hedge against that. And that's really the main thing why we diversify. So now you kind of know how to limit your volatility, but also if you want some volatility, why you should take those risks and why a lot of people take those risks. You have to kind of find out what's right for you. Rebel Leader, over and out.